move on with the show and let's talk about ELSS and tax saving. And for this, we have founder and CEO, Right Horizons, Anil Rego. Anil, good evening and welcome to the show. Equity-linked savings scheme. Everyone loves to save tax, but then very few people are aware about this instrument and the kind of benefits they have once they invest in it, and especially if you want to save tax and also have an equity exposure. What type of funds or schemes do we get under ELSS?
So basically, ELSS is an equity fund. Okay, so for investors, need to keep in mind that it's equivalent to investing in. Probably most of them are large cap oriented. So that's what you get into, which basically means that you also have the higher risk return. The potential of return is higher than non-equity avenues. At the same time, you must be also aware that there'll be volatility in between. But the 3-year lock-in that it has also ensures that over a 3-year period, normally the volatility sort of eases off and gets compensated for in between by market moves. So definitely it is something for a person to consider. The other aspect of an ELSS is the tenure. It's a 3-year lock-in, which also makes it one of the shortest duration instruments under the tax saving ambit. The other aspect that you can also look at is it is a lot more flexible in terms of not having to use the same scheme, same fund. Unlike, let's say, if you take an insurance, you need not be committed to continuing to use the same scheme. Of course, it's an option that you may use, but it's not a compulsion for you.
All right. Anil, now I want to understand how does these mutual funds work? Because we have a tax benefit, there is a lock-in for 3 years. Is the working different from the rest of the equity funds which are available? Do we also have a fund manager who's taking care of an ELSS fund and looking at the portfolio composition and things like that, just how we see in an equity mutual fund of other category?
Yes, the ELSS is very similar to an equity mutual fund of a large cap scheme, and it has all the benefits that mutual fund has. It has a fund manager. The data is always transparent and open. You can go back and even see a lot of statistics before you go and invest. You can look at both return as well as risk. You can look at return within different time frames. You can look at what is the underlying holdings in the portfolio. So it has all the benefits of a normal, say, diversified large cap equity scheme.
Some of them are diversified in nature. If by example you can explain us about a few.
Sorry, I missed your...
So are all these schemes diversified by nature and the kind of theme that they follow? And
yes.
if we can talk about a few existing ELSS that you would want to recommend later on the show, what would that be and how are they investing? To what extent are they diversified?
Yes, so they all are diversified. Of course, it would depend from, let's say, scheme to scheme, and one needs to go back and look at the underlying portfolio. You can also see what are the sectoral compositions of it. So those are aspects that you can look at before you invest, but it's just like, any other mutual fund scheme. Now, within the category of ELSS, there are a number of funds which are available almost from each fund house. The ones which are performing well today and based on both looking at risk and return, okay, we find the following schemes to be the best. We have Canada Robeco Equity Tax Saver. You have the Mire Asset Tax Saver Fund, as well as we also like the DSP Tax Saver Fund. You have, in between, you have a fund which is Quant Tax Plan, which has also done pretty well in the short term. Okay. However, keep in mind that it's a slightly higher risk fund. So somebody who doesn't want too much of volatility, that is something you can avoid. Okay, because it has a higher beta. It also is a smaller fund size. And from the volatility standpoint, it is something that one can miss out. But the top 3 are Canada, Mire, and the DSP Express.
Talking about volatility, is the same kind of volatility we would expect in the normal mutual funds that we would see even in ELSS?
Yes, the volatility also will be the same, and it's, I think, important that investors start looking at the volatility parameters. Mm-hmm. Now, most of the portals do also capture various volatility measures which you can sort of look at. Okay, so it would be the same, but since the numbers are reported, even within diversified equity large cap mutual funds, you'll find different schemes have different volatility levels. So that is something that you can track between them. There's not too much difference between a diversified and ELSS, but yes, from scheme to scheme, there will be differences, which is why an investor also needs to consider that also.
We will compare ELSS with PPF, FD and NPS. But before that, the plans that you've mentioned, what's been the return for like say 3 to 5 years?
Absolutely. So for example, Canada would have given a 3-year return of around almost like 19%, 18.67. Similarly, Mirae Asset would have given 18.92, and DSP Taxsaver, 17.14. On a 5-year basis, the returns are somewhere closer between 12.5 to 15% per annum, which is a very decent return considering that it's a compounded annual.
Now, the question comes how to select an ELSS scheme. Which do you think is the right fit for you, and how do you invest in it, through an SIP or lump sum? And also, should we looking at the 3-year lock-in period, because that's the main intention and the only intention of people normally, because a lot of time what happens is people just invest their money before the deadline period, and which is why they do not understand the nature of the investment product. So how do we look at ELSS now?
Yeah, so ELSS, I think, the way you look at it is very similar to how you would look at a normal mutual fund. Actually start off, looking at the fund house, look at the fund manager, see the performance of the scheme. And ideally, we would like to look at longer term performance, because you may have funds that are, the best performing on a 1-year basis. But when you look at it over a longer period, you may find that, it's not very consistent. So when you are investing, you don't know how it will do in the long term, so you'd rather choose a consistently performing scheme, which is why I look at 3 to 5 year, type of time frames, and also look at various other risk measures, like what we look at as standard deviation, Sharpe ratio. You have beta, the alpha will tell you how much it's done better than the benchmarks. So that is something that one would look at. And the other aspect that I would also like to bring about is, what is the risk profile that you want to have in your overall portfolio itself. So while you choose the ELSS, just look at, is this a risk that I would like to take, right? And based on a risk profile, if you are supposed to say if you like to have 80% equity, then you can also maintain that here. Or if you have debt elsewhere, then you can look at it in terms of the overall allocation to your portfolio.
All right. So clearly your time horizon should be more than 5 years. Yes, you have a lock-in for 3 years, but then do we get the benefit for investing continuously for 3 years, or if we have a lump sum investment, we can take the benefit for 3 years? How does it work?
Yeah, so from the tax benefit, it's from the time you've invested. Okay. So if I've invested, say, 25,000 rupees on a particular date, that's what you get it as a tax benefit for that financial year. Now, you can also do it through a systematic basis, and systematic basis, in fact, is a good thing to do for, equity-linked instruments. So, if you plan it well, it may be good for you, especially if you're salaried. It may just go very easily, rather than, coming to the end of the year and suddenly breaking your head that, I have to make a lack of investment in tax saving schemes. So that is how I think you can go about it. But there's no compulsion for you to only look at, lump sum or SIPs. There is no requirement for you to do the same scheme in the next, financial year, or even within the year, you can do multiple schemes.
All right. Now, if we want to compare this with PPF, fixed deposit, NPS, now ELSS has a 3 years lock-in, PPF 15 years, NPS is a retirement instrument including PPF. Now, how do we select? Is it important for us to have so many tax-saving instruments, or just one ELSS in your portfolio is more than enough? How do we look at it? How do we construct a portfolio?
Yeah, it's not a good idea to have everything, all your eggs in one basket. Mm-hmm. Okay. At the same time, if your risk profile supports it, and let's say you're young and can take a higher level of risk, then ELSS is not a bad idea. Especially, considering that liquidity, etc., you may use outside, your tax saving avenues. So you could use debt, which is a non-tax saving avenue. It will also give you liquidity as well. So you can do it, 100%, but It depends on completely on your risk profile. Okay, and coming back to the other avenues, if you would like to sort of diversify, keep in mind the tenure. So PPF, like you mentioned, is long term, 15 years. Of course, after the sixth year, you can sort of have some partial liquidity which is available. But keep those aspects again. Keep in mind, while you're allocating, how is the return coming out? Is it taxable or is it tax free? Now, ELSS schemes, the taxation is just like an equity mutual fund. So above 1 year, it is 10%, and less than 1 year, it's 15%, of course, plus surcharges. Okay, but let's say if I do a bank FD, the whole returns that I get would be taxable. Now, the FD has a 5-year sort of time frame, as lock-in. So you need to keep in mind, the liquidity in terms of the tenure and the lock-in. You also need to keep in mind the taxation of returns, while you look at it, as well as what is the return that you get from the particular avenue, as well as the risk profile, and how risky is each avenue, and accordingly construct your tax saving investments for the year.
A lot of people, what they do actually is they just have tax saving instruments in their portfolio. How should we look at it? I mean, obviously, it's a very important aspect of your portfolio. You should be having tax saving instruments, but at the same time, you should have investment instrument lined up with your goal. So PPF, NPS can be for your retirement, but then what about ELSS? What about tax-free or tax-saving fixed deposit? How do we align these kind of investment products with your goals?
Yes, it's very important to also consider what are your priorities and your goals, and accordingly, look at investments, including tax saving. Sometimes you think that, okay, tax saving is only for tax, but no, ideally you should be doing a financial plan for yourself. But if it is, if your asset base is not as large, it may not make sense to, actually engage a financial planner, in which case, you can just do it a little bit of yourself by reading. But start off with the ELSS as for somebody who's starting their career. That may not be a bad way to start. Okay, but as you graduate, I think you need to start looking at other avenues. Ones like PPF have a fantastic, tax-free return on the debt side, which you don't get anywhere else. So even if you don't have a tax benefit, many investors still look at it. So actually, you need to match both liquidity with your needs. Okay, so if you have something coming up in the next 1 year, then plan accordingly. But if most of your needs are 5 years, 10 years, sometimes even 25 years, then you can sort of look at ones like ELSS. You look at the tenure for your debt instruments, and you also need to keep something outside your tax saving, right? Because in case of liquidity, you don't want to be running around and taking a loan. So it's ideal to use a combination, use it judiciously, and take care of your needs. Okay, so that you're able to achieve your goals as well while looking at your tax saving.
Very important. You need to tie up your investment with your goals, and in this you can definitely make use of ELSS not only for tax saving but also to accomplish your goals. Thank you so much, Anil, for removing time.